Hi everyone, Donnie Schultz, Embrace Home Loans, Friday, January 14th, here with a market update in what has become a tough start to the year for the mortgage industry. So as many of you are aware, interest rates have been under significant pressure since Monday, January 3rd, since the start of the new year, when traders came in and started repositioning for the shifting expectations for rates going into 2022. So the main driver behind the most recent move has been inflation and what the Federal Reserve is going to do to shift their policy to fight against inflation getting out of control. So there's a couple different thoughts on inflation right now. One is that it is transitionary due to supply chain issues. This new COVID variant adds to that pressure as more people get sick. That supply chain resolution is getting extended out. That's adding some pressure to interest rates. And the Federal Reserve has to pull back on their stimulus, on the support that they're giving to markets and the liquidity that they're giving to markets to keep inflation from really becoming a major problem moving forward. So what markets what markets were anticipating were 3 interest rate hikes throughout 2022, and for the Federal Reserve to slowly reduce the amount of mortgage-backed securities and treasuries that they buy on a monthly basis. Right? That's part of the support that they put in place when the pandemic hit. They provided liquidity to the markets by purchasing these assets on a monthly basis. So they're going to be reducing that. They told us, hey, there's going to be rate hikes. We're going to reduce the amount that we buy, but the projection has accelerated now. 3 rate hikes, most analysts are expecting 4 to 5 now. We know the Federal Reserve is going to reduce the amount of treasuries that they're buying, but they also released minutes from their last meeting on Wednesday or last Wednesday that showed that they were talking about not only reducing the amount that they buy on a monthly basis, but also reducing the amount of treasuries, mortgage-backed securities that they hold on their books. So they're going to be reducing their balance sheet. That's bad for interest rates. So what we saw is rates that were in a pretty narrow range going through the fourth quarter of 2021 to January 3rd hitting, and all of a sudden we've seen this big drop. Okay, and when mortgage-backed security prices or yields move lower, rates move higher. So as this trend line goes down, interest rates are moving up. Probably about 0.5% across most programs across the board for lenders. That's what I would expect if you're comparing rates from December 31st to today. You're probably seeing a 0.5% difference. So if you have clients who are pre-approved at a 3% interest rate, they need to connect with their lenders and they need to know what those payments look like at 3.5% today. It's tough to say if we're going to see any kind of bounce backs. Earlier this week, we did see markets try to attempt to gain a little traction back in the other direction. That was rejected today, as you can see by all the red on my screen here. So markets said, hey, nope, we're going to continue moving a little bit higher here on rates. Eventually, traders will get to a position where they feel comfortable with what to expect in 2022, and then they're going to see what actually happens, right? 4 interest rate hikes could turn to 3, could turn to 5. I think right now the trend is for higher rates. Clients have to be locking in. So once you go into contract, take those rate locks, take the risk out of the equation. A lot of lenders like us, we offer long-term locks, 90 to 105 days without cost to the borrowers. And we also have aggressive float down features in case markets do turn and we see a bounce back lower. We have options to lower that rate before closing if borrower meets float down eligibility. Okay. Second thing that hit the mortgage industry a little bit hard this week was the announcement by Fannie Mae and Freddie Mac about a change in loan level price adjusters for high balance mortgages and second homes. So high balance mortgages, any loan above $648,200 up to the high balance limit, $978,000. Those loan level price adjusters have gone up to a point where it's going to cost the borrower an additional 0.75 in points or about 1/4% in interest rate on their high balance mortgage. Okay, so the loan level price adjuster that used to be passed on to lenders for banks like myself was 0.25%. It's gone up to 1% or 100 bips. So just to explain real quickly, when we say 100 bips or 1%, that's not an increase of rate from 3% to 4%. It's essentially what we would call a point, right? 1 point is 1% of your loan amount. If you're taking a $600,000 mortgage, 1 point is $6,000. So in this case, the cost has gone up by 75% for those borrowers on these rates. It's pretty much effective immediately in New York State for loans delivered to Fannie and Freddie after April 1st. So anything closing or anything going into contract now is not going to meet that, that closing date or that delivery. So you're going to see this applied to lenders' rate sheets across the board right now. Second announcement was for second homes. Second homes used to be financed they used to be priced very similarly to primary residences. If you were buying a second home, you could finance up to 90% of the value of that home, and your rate would be very similar to, if you're buying it as a primary residence. Fannie Mae and Freddie Mac changed those loan level price adjusters significantly and made second home pricing almost identical to investment property financing. You can still finance up to 90%, but you're going to have over 4 points in additional fees. So if you're buying that $400,000 mortgage second home a week ago, rate would cost you $0. Today, it's going to cost that borrower a little bit over $16,000 in cost to get that same interest rate. So really important if you have any borrowers who are in the second home or vacation market, they're looking at high balance mortgages, reconnect with your lender. We're going to see a lot of these high balance mortgages go over to the jumbo side just because of the lower rates on those programs right now. If you're financing or maximizing your financing, you have to be ready for that additional cost or that rate increase. So really important for buyers right now to be reconnecting with their lenders, looking at numbers, making sure that they know exactly what the budget is for these homes that they're going to be going and making offers to. If any of your clients need any assistance, me and my team are always available. Any questions, don't hesitate to reach out. Hope everybody has a great weekend.